President Trump says he is not thinking at all about Americans' financial well-being when it comes to the war in Iran. And he says he meant it. This weekend, he called that a perfect statement. But new polling shows that Americans don't really feel his work on the economy is perfect. With us now, CNN chief data analyst Harry Enten. So not perfect at all when you compare their feelings about what Trump will do to the economy a few years ago to now.
Yeah, you know, the promise of a Trump presidency in the minds of the American people have turned into a reality, and a reality that for them is a nightmare. Because just take a look here. Okay, Trump will or is making you financially worse off, better off. Back in October of 2024, the reason why he won a second term, 44% said better off, outrunning the worse off at 38%. But look at these numbers. Down through the floor on the better off now, just 14%. Just 14%. I see Johnny off on the side shaking his head. Trump making them financially better off. Meanwhile, the worse off up like a rocket. The clear majority now, 57% of Americans now say that Trump is making them financially worse off. You know, back in 1980, Ronald Reagan asked, are you better off than you were 4 years ago? As Americans look back now, compared to a year and a half ago, their minds on Donald Trump are definitely saying he's made them worse off.
I mean, look at that drop, a 30-point drop in a couple of years. And if you think 14% is low.
Yeah, if you think 14% is low, how low can you go? Well, how about this? Okay, Trump will or is making you financially worse off, better off among independents. Look at this. The better off now is just 8. It's just 8. When you can count it on your hands, you know the number is low. Just 8% say that Trump is making them financially better off among independents. Way, way down from the 40% who said that back in October of 2024 when the better off was outrunning the worse off at 38%. Look at that. That 38%, again, up like a rocket. I feel like I'm at NASA. Look at this. 64% of independents now say that Trump is making them financially worse off. These are numbers we've seen among independents over and over and over again. They have turned against Trump, and now about two-thirds.
I mean, these independent numbers are staggering. I mean, 8% is not zero.
No.
But it's closer to zero than it is to 50.
That's exactly right. When you're closer to 0% than you are to 50% as a politician, you know your numbers are bad.
All right, independents obviously a key swing group. What about some of the groups that were key or have been in the past to Donald Trump's electoral success?
Yeah, normally you want to be winning over independents because the way independents go is the way the nation goes. But you definitely want to be holding on to your base. And of course, one key part of Donald Trump's base is non-college whites without a college degree. And even they are flipping on the President of the United States. Trump is or will make you financially worse off, better off. Back in October of 2024, look at that, 54% better off, well outpacing worse off at 30%. Now we're looking at basically the inverse. Just 15% say better off among white voters without a college degree. Trump is making them financially better off. And now even there, the majority of non-college whites, a key part of Donald Trump's base, are saying he's making them financially worse off. These are numbers that would make me, if I were a Republican running in the midterm elections, be quite worried.
These numbers are sure telling a story. The question is, at 1600 Pennsylvania Avenue, are they reading it?
According to the Consumer Price Index data, U.S. inflation rose to 3.8% in April. That's the highest rate of inflation in almost 3 years, in part due to the Iran war. Americans are feeling the economic pain. Meanwhile, the stock market has kept going up. What should we make of all this? Joining me now is Jason Furman. He is a professor at Harvard's Kennedy School and the former chair of the Council on Economic Advisors under President Obama. Jason, thanks for coming. So first explain to us, how significant is the rise in inflation? And let's take them, a kind of a best case scenario, which is the Iran war is resolved in, let's say 6 weeks. Does it persist or does it rapidly come down?
Yeah, so Fareed, you have to understand there's two big things going on in the economy right now. One of them is the Iran war. The second is the enormous demand from the AI build-out. Both of those are adding to inflation. One of them is helping the economy, one of them is hurting the economy, so they're canceling out to a draw when it comes to something like the unemployment rate. When you're thinking about inflation going forward, I think the Iran war part of it could probably be transitory. But I say probably because it depends on the degree to which it gets built into people's expectations. The AI build out and the extra demand from that actually might have more of a permanent component to it.
So when you look at the micro data in the U.S. economy, earnings, and not just of AI companies, but earnings in general, fairly strong. The stock market keeps going up. Unemployment rate still very, very low. I guess it's not micro. I'm going to mix some data points seem to be very positive. And then you look at inflation, you look at consumer sentiment, it's very bad. What is the picture of the economy? I saw somebody say the U.S. economy is weak in every way except it is one massive on artificial intelligence, which is keeping it going.
Yeah, I think that's about right. A really disproportionate share of our economic growth over the last year has come from that one sector, from building data centers, from building the power that they need. And you can look at different parts of financial markets and they tell you about different parts of the economy. So the stock market tells you what you expect corporate earnings to be, but it also tells you about risk, inflation, and it's all bundled together. And on balance, the higher expected earnings are dominating everything else. That's why it's done well. But then look over at the bond market. That doesn't care about corporate earnings. All it really cares about is risk, expected inflation, those types of things. It's a really pure measure of that. And interest rates are incredibly high. They rose a lot over the last week. The 30-year is the highest in nearly 2 decades. And you're going to start to see that, by the way, in mortgage rates. So it's going to be really concrete and tangible for American families.
So in the 1970s, we had a Middle East war. We had energy prices go up by a lot more. Energy prices tripled after the oil crisis. And we had a president, Richard Nixon, who bullied the Fed chairman to lower interest rates. And that time, the Fed chairman, Arthur Burns, agreed to be bullied. And the result was we got a combination of slow growth and high inflation, which people call stagflation. What's the danger of something like that happening this time around?
Look, I think it's a danger. It's one I'm going to be watching closely and certainly commenting on and warning if I see it materialize. But right now I'm cautiously optimistic. The incoming chair, Kevin Warsh, I didn't love everything he said to get the job, but he's a serious person. He's going to care about his standing in history. I don't think he's going to want to badly mess things up. And the other thing to understand is interest rates are set by a committee of 12 people. It's a majority vote. The chair is 1 out of 12 votes. And right now the committee is thinking in a very independent way. At the last meeting, 4 different members dissented. And so I don't think the chair can walk in there and say, here's what Donald Trump wants, here's what we're going to do. He's going to have analytically persuasive arguments, or the committee's just going to say, no, we're going to vote on something else. So I think there's some real checks and balances there. I feel okay about it, but I don't feel 100%, so I'll be watching carefully.
Quickly, we don't have a lot of time, but Kevin Warsh has struck me most of his life as an inflation hawk. When you were in the White House, he was assailing you guys. He was saying there was too much quantitative easing. The Fed was being essentially too dovish. It feels like he's somehow convinced Trump he's dovish on inflation. Do you share my view that underneath there's somebody who's generally speaking wanted rates higher for the last 20 years?
Yeah, I think that's right. And look, Donald Trump, I think, was nervous about this. He probably would have named him a year ago if he thought he would do his bidding. But I think what he was going through his head is, this is a credible person. Financial markets respect him. But I'm nervous that he's too independent, that he's not going to do what I want. And that's why he dithered, tried other options, thought about other things, and eventually came back to Kevin Warsh. So I don't think he was exactly what Donald Trump wants. I think it's possible he'll be closer to something that the rest of us want. But again, we'll have to wait and see. And the other thing about Kevin Warsh is he's been a real critic of the Fed. He's never said exactly what he's going to do differently. And so trying to understand what his affirmative vision is and how he fleshes that out is still a little bit unclear. And I'll be watching all of that as we go forward.
Jason Furman, thank you. That was so helpful.